Okay, but of course the overarching theme will be the white knight that has come in the form of UBS, where UBS has bought Credit Suisse for $3.2 billion to stem the banking crisis. But there is a banking crisis underway, both in the US as well as in Europe. So how do our markets deal with it? Matt Orton, the chief market strategist at Raymond James Investment, joins in to talk about that. Matt, thanks a lot for being with us. There's so much news flow that has transpired in the last 48 hours. As a strategist, how do you deal with it? Do you think there could be more pressure in risky assets like equities over the next couple of months?
Good morning, Sonia. Good to see you. It's been a complicated past week and a half. I'll say that for sure. There's been absolutely no relief in terms of the news flow that continues to come in. And I think when I talk to clients and try and distill a lot of what's been going on in the markets and behind the scenes, the best message that I can give is there's no reason to chase the market in either direction. There's a lot of unknowns that are out there. There's a lot of uncertainty that's out there. This banking liquidity crisis is caused by a crisis of confidence and uncertainty. And so the best thing that we can do is continue with the playbook that we came into this year, which is remain defensive and let the market come to you. So in terms of looking at companies, how your portfolio should be positioned, wanting to own companies that have cash flow generation, that have some form of earning stability, those are going to continue to be really important moving forward, and let the news flow come in and digest it. This is not the time to be trying to catch falling knives. It's not the time to be trying to bottom fish. We really need to let the news settle and digest it. And eventually, at some point, there's going to be a lot of good quality names that have been thrown out with the bathwater, but we are not there yet.
Matt, hi, good morning. Okay, so let's talk about the immediate here and now. Given that there's this coordinated, intervention by central banks, there are joint statements, there are these dollar swap lines, the SNB has come in with almost a complete backstop on whatever potential losses arise. Do you think the markets can see a bit of a relief rally? Or should we now look out to the US and figure out what's happening there? Because I've got to mention this earlier. First Republic Bank shares stand 30% despite this $30 billion deposit show of strength coming through. So what are we looking at in the next couple of days, you think?
So I think first and foremost, it's important to remember that global central banks have got a lot of experience putting out fires over the past decade, especially after 2008. After the European banking crisis in 2011 and 2020. So we should have confidence. We're seeing that confidence play out, that global central banks and regulators are doing what they need to do to try and make sure that this liquidity crisis doesn't have broader systemic issues. And I don't think it does. And the ECB did something I think that's very important and that we're likely to see the Fed follow this week on Wednesday, which is to separate monetary policy from the liquidity challenges that we have in the market. Because the fact of the matter is, inflation is still too high. Pressures on core inflation, wage pressures here in the US, they are still incredibly elevated. And we can't let that fester. The Fed can't lose the credibility that it has worked really, really hard to regain over the past year. So I expect that we're going to see a 25 basis point hike. And I think what's going to be key to the market going forward is what the dot plot looks like. Are we going to see terminal rates at around 5.25? Are they still going to be higher than that? Because I think if you see the dots continue to remain elevated north of 5.25%, that might give the markets a little bit more of a room for pause and to be spooked a little bit, because again, a lot of these issues were brought on because of the rapid rise in rates. So hopefully we'll see them reemphasize data dependency going forward. But I really think the Fed is going to hike, and then we'll see how it plays out from there. But I don't think the markets are going to stabilize until we get through the Fed on Wednesday.
All right. Hi, Matt. Morning from here in India. Matt, I was looking at the probabilities, and 62% of the street is still factoring in a 25 basis point hike, while optimistic 38% believes that maybe there will be no rate hike. Let's see what happens on that front. But I've taken your point about 25 basis point rate hike. Matt, the last time you joined us, you said you still prefer India over China. Now, from your equity allocation that you'll be looking at on global equities, do you think that there will be more capital that will be allocated to India post this recent correction that we have?
I think India looks more appealing, Prashant, as prices continue to come down. I mean, India hasn't been this cheap. I mean, really, since almost 2020, we're basically at the lows on a forward PE basis of where we were the last time the market bottomed in September of last year. So there's a lot of potential. I think, like you'd mentioned before in the segment, if short covering happens to come in, if we get better news, I think that can help the markets move higher. We've held on to close to some key levels. I think when I look from a broader asset allocation perspective, I like to own areas that are a little bit cheaper, that have strong idiosyncratic fundamentals. And I think India fits that bill. A lot of Indian banks, even though there is a banking crisis, they remain in good shape. I think we've seen them perform decently well, all things considered, relative to global financials too. And you've seen some strength in cyclical areas over the past week or so in materials and industrials. So that is encouraging to me beneath the surface. As I look at the world as a whole, my strongest region of preference that we've talked about before is Asia ex-China. So I like a lot of the countries that are levered to the China reopening theme, that don't get direct exposure to China just because of the regulatory risk. And we're continuing to see some of those issues play out. So countries like Thailand, the Philippines, South Korea, Taiwan, you get exposure to a lot of strong improving fundamentals in those countries, reopening trade around the world, most importantly, China's reopening, which continues to play out. And you also get exposure to some of the uplift we're starting to see in the global semiconductor cycle. And I like that because that year we've seen earnings momentum bottom, and those types of companies can drive those markets higher. So there's definitely opportunities from a global perspective.
Got that. Just one final question. Coming back to where we started, you said it's better to be defensive in this market and don't catch a falling knife. How much more do you think this knife could fall? Because for now, the markets are calmed by this UBS Credit Suisse deal. But the million-dollar question is whether there are more banks coming that could perhaps, collapse like this. Do you think that there is a deeper fall coming into the markets and hence you're defensive in nature?
I certainly hope not, but you can't rule it out, right? I always go by the greater cockroach theory. Whenever there's one or two, there's going to be more that come out. And that's what we're starting to see play out. Hopefully, it is very, very contained. So far, the issues that we have seen have been very specific to challenges that some of these banks had, and I would say improper risk controls. And so the issue of systemic failure, I don't really think is there. How the market reacts to that, it's really difficult to say, because I would say the repricing of volatility and interest rates and the repricing of Fed expectations has just been nothing short of spectacular. I mean, we've gone from starting this year pricing in rate cuts to pricing in no rate cuts to back to pricing in 100 basis points of rate cuts again. I mean, the volatility has been absolutely crazy. So there's one thing that's for sure. Vol is here to stay, and it's better to sit on the sidelines and let it play out, lean into quality, and then pick up the pieces later.
Absolutely, Matt. I go back to my analogy of that crazy driver on the accelerator, right? So you go from 100 to 20 to 50 to 30 to 120. That's been this year so far. But thank you. Your points are well appreciated. And maybe we'll have to just call you back once the Fed is through to make sense of what's going on in the world after 3 days. Thank you so much for joining us, and you have a great session today. We'll take a break on that note. On the other side, we also boil this down to stocks, actually lots of stocks as well that you should watch out for today as trade opens up. So our top 10 list coming up.